Good morning. Today is May 4th, Thursday. I'm Joe Terril, President of Terril and Company, Private Wealth Managers in St. Louis, Missouri. This is another video update where we express our opinions about particularly investments, but also the economy and events that are going on in today's world. Joining me are two other members of the investment committee. On my right, long-time veteran here at Terril and Company, Dave Carter, and on my left, Russ Phillips, who has also recently joined Terril and Company after a long stint in the investment community. So what we wanted to get across today was how we are positioning clients' portfolios for what's going on, the current news today. We see several things that we want to just have a little discussion about. One is the regional banking turmoil, where regional banks are getting a run on their deposits and they're being forced to sell bonds that are now underwater because of the increase in interest rates, and what this may or may not affect in the economy. The second thing would be the upcoming political debate on how are they going to extend the debt ceiling, what are they going to do about the budget deficit that some people are predicting is going to be $2 trillion this year, and what are politicians in Washington, D.C. going to do. And then the third thing, of course, is the higher interest rates, that environment that we're now in, which was reflective yesterday in the Federal Reserve raising short-term interest rates by another 0.25%, and the debate about how long will these rates stay higher, or the other side of the coin where some people are arguing that the Federal Reserve Bank will reverse policy, pivot is the term they use, and begin to cut interest rates as early as this summer, and therefore you should have your portfolios positioned for this. So in general, because of these things, we are continuing to be very conservative. We're continuing to hold a lot of liquidity because we think we'll get better buying opportunities as the year goes on and the markets have to deal with these issues. But with that said, Russ, let me ask you first about buying opportunities. Are the markets going to worry enough about these things, and are they correct to worry about them, that we'll get good buying opportunities?
Joe, I think we will get good buying opportunities. You're seeing that in a day like today, when the regional bank crisis concerns, whatever you want to call it, are causing a little bit of market volatility. I think market volatility is probably key to the future movements of the market. Market's really been in a wide trading range since January of 2021, with a lot of volatility, and I think there's going to be a lot of volatility ahead, just as you mentioned. Debt ceiling concerns, regional bank concerns, concentrated performance concerns in a few of the FANG-like stocks, so Facebook, Amazon, Netflix, Google. So opportunities are starting to approach. Our team is sharpening our pencil.
Are they back to talk a little bit about, let's say, the S&P 500? How much of the performance of the S&P 500 is now back to being concentrated in just a few names? And that was the issue that occurred post-pandemic in 2000, that everyone ran to the same names, and it ended badly for everybody. Are they back to doing that right now?
Sure are, Joe. Basically, about anywhere from 5 to 7 companies in the S&P are representing anywhere from 80 to 90% of the performance of the S&P. Does remind us, we've had discussions about this. How about a little bit about the Nifty 50? It also reminds us, as you mentioned, in 2020, 2021, coming out of COVID, we had concentration in those stocks as well initially, and then things broadened out. Market is moving from being broad performers to being very somewhat narrow in terms of the performance.
And can you tell our viewers about these one-day stock options that has to be the epitome of speculation? Are people really buying options that expire by the end of the day and gambling on what's going to happen on some of these stocks day to day? That to me is again saying, well, the Fed's not tight. People have all kinds of money to be doing this. I don't think the Federal Reserve can be called tight on credit.
So you've been correct in your call on the economy that, the economics are strong. People have jobs, people are spending money. Just look at Royal Cruise Line's bookings, very strong. I think Norwegian was earlier, they had strong bookings. So you've been very correct on that call. In terms of the what are called 0 days to expiration, DTE options, they do represent volatility and they do represent some speculation, and they are causing volatility in the markets. You can see that in the intraday swings of the market daily. So what it's really causing people to do right now, as we mentioned earlier, was narrow their leadership, narrow their holdings, which eventually will allow us an opportunity, as I said, to find other opportunities, whether it be in the banks, whether it be in existing holdings that we might have. We're going to find those opportunities coming up over the summer.
So that's mainly going to be as they concentrate on some of the glamour names and speculate on those and run those up. Everybody else, the price is very reasonable, getting even more reasonable. That's where we're going to get our opportunities.
100%.
I think so. I agree with you. Dave, talk to a little bit about this banking crisis. Can you try and explain to people in a short time frame why this isn't maybe what the public thinks it is? I mean, we're used to seeing banks go broke because they lent money to people who can't pay them back. That's got nothing to do with this right now. Just how do you think this is all going to play out?
Well, Joe, that's right. This is not a situation like 2008 in the great financial crisis. This is more of a liquidity situation, which sort of reminds me of the savings and loan crisis back in the late 80s, which banks lend long, but their deposits are short, and the banks that we've seen being taken over and gone under, all have had very specific, unique business models. A community bank that lends to a broad community customer base that has lots of deposit customers and lots of traditional business customers in the community will be just fine. They don't have a concentrated deposit base that can move their money in an hour. They have their money on deposit to run their businesses, to make payroll, and those deposits are sticky. And the market became concerned because they saw losses, market losses on their investment portfolios, and those losses are only losses if they have to sell. Banks have the benefit to own those securities to maturity, and the Fed is supporting that through various programs. So you will see, I think, some additional banks go away, but they have unique business models that are not strong, fundamental, traditional banking businesses. And so I think this will pass in time. And, you know, once it, you know, and also it will do some of the Fed's work for them. It will tighten lending and tighten credit. And so that's gonna potentially keep inflation down, which is, I think, one thing they want. But all in all, this is not a credit situation, and this is not a, you know, in our mind, a systemic banking situation.
So, we were talking about the economy a few minutes ago. The economy does seem to continue to be strong. The consumer is spending, and predictions about auto sales, no one's talking about auto sales falling off a cliff until we see something different. We think that the economy will continue strong, which will give the Fed the ammunition to keep these interest rates higher for longer and battle inflation, and the markets are not set up for that. You guys correct me if you disagree, but I think the markets are set up for the economy's going to turn bad and the Fed will radically cut interest rates, and that'll spur all types of buying, etc. We disagree with that, and we think when the market comes to the conclusion that the Fed is not getting ready to cut interest rates, they're going to reevaluate prices lower, and we'll be rewarded with the liquidity we have to be able to buy at much cheaper prices. So let me thank Brian Curtis, our producer here of our videos, as always, and we'll be back as needed as events come up, etc., with an update on our thinking. And we thank you for joining us today.